For most Australians, owning your own home represents the biggest asset you'll ever own in your lifetime. But what a lot of people don't realise is it could also represent your biggest missed opportunity. For many people, your home is just somewhere that you live and you spend decades chipping away at the mortgage until it's eventually paid off. But what if I told you that there's a way that you could actually use your home as more than just a place to live and raise a family, but also to accelerate your wealth, save on tax, and actually put in place a strategy that will help you pay off the mortgage even faster using passive income? The strategy we're talking about here is debt recycling. And in very brief terms, how it works is you've got your mortgage, which is considered a bad debt because the interest that you pay is not tax deductible, and you have to pay that interest and obviously the principal as well with after-tax money. So it is effectively the most expensive way to pay off a debt. Good debt, on the other hand, is debt that you use to buy investment assets, be it shares, which produce dividends, which is taxable income, or an investment property, which produces rent, which is also taxable income. And because those assets are generating taxable income and potentially a future capital gain, the interest on that debt is fully tax deductible. So that is why it's considered good debt. So what the concept here is as you pay down your bad debt, your mortgage, that creates equity in your home. And then you use that equity to draw an investment loan that you can then use to buy a share portfolio or an investment property. Both of those assets will generate income. That income you can then use to help pay down your home loan faster. Plus you get tax deductions that can also be directed onto your home loan. And the faster you pay down that home loan, the more opportunity there is to draw even more investment loans out, accelerating the strategy even faster. But while that all sounds great, and it will result in you paying off your mortgage faster, saving a bunch of tax, and having an asset that hopefully will grow over time in addition to your home, whenever you borrow money, there are naturally risks attached. And that's why getting advice to ensure that this strategy and what you use that debt for, be that shares or property or both, is sensible and suitable for your own personal situation, because interest rates can rise, cash flow can be compromised. So getting this strategy right is really important. We've put together a blog which you can follow via the link below, which steps out this in a little bit more detail, including a bit of a case study for you. And if this is something that you would like to investigate further, we invite you to book in a session with Link to go through this strategy and how it might work for you.